First Citizens increased by 46%, making it a good deal. However, some complain that the FDIC is left with $90 billion of unwanted assets and loans, resulting in a $20 billion loss. This is not the global financial crisis. The Fed and government reacted quickly 2.02 weeks ago to prevent liquidity issues. The Credit Suisse situation was resolved a week ago. The second and third largest bank failures in history have been resolved. FDIC reserves were $128 billion at the end of the year. The $20 billion hit will cost banks about 3% of their earnings over 3 years and higher FDIC assessments. The average deposit size at Silicon Valley Bank is over $1 million, compared to a typical bank's retail deposit of $10,000. Silicon Valley Bank was forced to sell unrealized securities losses, but this is no longer necessary due to the Fed providing liquidity. The idea of a forced mark-to-market liquidation value of banks is not applicable, as there is now good transparency in valuation. During the global financial crisis, Citigroup had $50 billion of CDOs on their balance sheet, and Merrill Lynch initially denied having any left. However, now there is good transparency in valuation, and banks are not forced to sell securities due to the liquidity provided by the Fed. Regarding the hold-to-maturity, treasuries, and good loans, experts like Chris Whalen and Josh Rosner have discussed them. However, concerns arise when examining portfolios that include commercial real estate loans and mortgage-backed securities. It is unlikely that the Fed will provide liquidity at par for these loans. Bank stocks are discounted due to a crisis of confidence caused by one event. The government is taking action to overcome this, including using a $20 billion payment from the banking industry.